Hello and welcome to everyone to this special session on COVID-19 and monetary policy. Thank you for joining us from all over the world, our friends in Indonesia as well. Welcome to this session. This session has got 4 papers. As I said, they're on the theme of the pandemic and monetary policy. And this is a joint collaboration between Bank Indonesia Institute, and the Asia Pacific Applied Economics Association. I thank Bank Indonesia for very kindly sponsoring this session and bringing to a world audience the first set of papers that we believe address the issue of monetary policy in the pandemic. And I hope that we will be able to learn new insights and develop further research agendas out of these presentations. So we have an hour. What we will do is I'll let the 4 presentations take place first, and then take all the questions towards the end. We can go 10 minutes overboard. We have been allowed some extra time to squeeze in some questions and answers and clarifications. So we will do it that way. So the first paper is the Understanding Market Reaction to COVID-19 Monetary and Fiscal Policy Stimulus in Major Asian Economies. And that is going to be presented by Professor Syed Rizvi from Lahore University of Management Science. You have 15 minutes on.
Thank you, Professor Paresh. Can you see my screen?
Yes.
The PowerPoint slides. All right. Thank you. All right. Thank you very much, Professor Paresh. Thank you to the APAEA, World Congress organizers, and Bank Indonesia specifically. All right. So this paper is basically co-authored by myself, Dr. Solikin from Bank Indonesia, and with Professor Paresh from Monash University. So the just 1 second. So the introduction. So the idea behind this paper originates out of the vast literature that has come out over the last year and a half on pandemics and financial market. There's a huge literature which delves into how the financial markets responded with the pandemic, the massive volatility that we witnessed, the drop of nearly 40 to 50% in the market capitalization of the developed financial markets in the developed countries, especially within the first 2 months. Most of the literature focuses on lockdowns, travel bans, infection rates. Some of the newer literature is now focusing on vaccination availability and financial markets. Now, one of the things which has been missing in this whole literature, which has come up over the last year and a half, is the missing link between the fiscal and monetary interventions. Now, the case of fiscal and monetary policy measures is has been very or has come up quite a lot during this COVID pandemic. All over the world, policymakers have gone in with large economic stimuluses, which have been supported by coordinated monetary and fiscal policy measures. Now, the whole idea has been that all of these measures, they tend to exert short and medium term effect on the financial markets. Now, in the whole literature, this has been where we have noticed that has been missing to a great extent. A couple of questions. We have seen phenomenal and record-breaking economic stimuluses. We have witnessed monetary actions by policymakers all over the world like never seen before. A key question that is left hanging is how effective are these policy measures? Did these announcements help the financial markets recover? And the follow-up question after that is, was the reaction of financial markets heterogeneous to fiscal and monetary policy announcements, or was it homogeneous? Um, the assumption is that it is going to be heterogeneous. And that's where this whole study comes in and explores. So the scope of our study is primarily, we're trying to explore using a risk factor model, accounting for all conventional market risk, the questions that have been mentioned earlier. And also to compare abnormal returns, if any, with augmented risk factor models that include policy announcements, both fiscal and monetary. Now, our data set. So we have actually focused ourselves on the four major ASEAN member countries. It's Indonesia, Malaysia, Singapore, and Thailand. Our time period is from February 28, 2020 to March 2021. And for equity markets and for financial markets, we've used their benchmark equity indices. Now, after that, we actually went through all the monetary and fiscal policy announcements that were made by the policymakers in these countries. And we basically relied on the Bloomberg data and the news services. So what we came across were there were 26 for Indonesia, 21 for Malaysia, 8 for Singapore, and 17 for Thailand. These were the monetary and fiscal policy announcements made during the sample period that we are considering. Then those were filtered for substantial announcement, which were based on quantitative measures. So basically announcements which talked about fiscal economic stimuluses, or in monetary policy, which basically were quantitative easing or quantitative tightening measures, changes in interest rates. And after filtering, and so we said that, because there were some announcements in the whole data, which were just more of guidance announcements, not any substantive quantitative measures were taken. So filtering on that, what we actually end up getting is that in terms of fiscal announcements, fiscal policy announcements, there were 4 for Indonesia, 4 for Malaysia, 5 for Singapore, and 4 for Thailand. While in the case of monetary policy, there were 6 by Indonesian policymakers, 5 by Malaysian policymakers, 2 by Singaporean policymakers, and 6 monetary policy announcements with substantive quantitative measures during the sample period. Sorry. Now, the methodology. So basically, once we have all of that data, we have for our preliminary results, or for our exploratory results, what we did was we relied on a 3-day and 7-day post-announcement reaction of the market. And that has been done through just looking at the average returns and the volatility. And for volatility, we have primarily relied on the gauge volatility of the e-gauge volatility of T of the market. Now, and for our major part of the study, we've actually used a risk augmented model, and we've relied on an OLS model, which has been corrected for heteroscedasticity using the new Invest 1997. So essentially, the risk augmented model that we are using is basically the market which incorporates the market premium, the small minus big, the size premium, which is basically, and the high minus low, and these are the pharma French factors. Then we have also controlled for the day of the week effect, because there's a plethora of literature which talks about the stock market's reaction to any kind of announcement, be it on firm stock level or at aggregate level, that relies on the day of the week effect as well. So we have actually tried to control for that as well. And then we have the dummy variable for the monetary and fiscal policy announcement. And so how it works is that the day the announcement is made, that is the day it's won. And then if it's a 3-day or a 7-day, it goes on for 3 days and 7 days after that. The preliminary findings. As I mentioned, our exploratory one was based on just looking at the average returns. Our first column basically shows us the average returns of the full sample. Second and third column show the 7-day and 3-day post-stimulus announcement, and that is aggregated for monetary and fiscal. And then we have the breakdown in 7-day windows and the 3 days windows for each fiscal action and monetary action for each of the 4 countries. Now, so generally, it's from here it seems that Indonesian and Singaporean markets, we notice that there is overreaction. There's a negative reaction to announcements. While in Malaysian and Thailand case, so there's a 7-day impact is positive for Malaysia and Thailand, while it is negative for Indonesia and Singapore. But then these are just average returns, just the exploratory finding. Our main key findings, and that's where we use the risk augmented model, which I earlier talked about. So we used multiple models, primarily as robustness to check. So on our base model, the abnormal losses without the stimulus effect. I'll discuss it country by country. In the case of Indonesia, was 4%, and with significant. Post 7 days after the stimuluses, the abnormal returns came down to around 3.83%. And this is for aggregate monetary or fiscal, not differentiating between them. While in the case of fiscal stimuluses alone, the abnormal reduces came down to 3.38%. Now, in the case of Malaysia, the 7-day post-stimulus effect is statistically significant, but with a very small 0.0034% return effect on the return. In the case of Malaysia, we actually couldn't find any robust effect for the policy stimulus, be it directly or indirectly through abnormal returns. In the case of Singapore, what we actually found was that without stimulus, the abnormal losses were 2.43%. But with stimulus, the market losses seem to have disappeared, as all abnormal returns are statistically zero. And that was something which was which piqued our curiosity as well. In the case of Thailand, the abnormal losses without stimulus stand at 3.16%. So in the bracket, you can see the T value. The abnormal losses are higher, interestingly, with monetary policies post 7 days. The 7 days after the announcement, they stand at 3.3%, but with the fiscal policy announcement, they are lowest at 2.48%. Now, essentially what we conclude, so this is a preliminary study. So what it seems to us that fiscal policy is more effective. And why we are saying is that in at least 3 countries, Indonesia, Singapore, and Thailand, we actually found that fiscal policies did aid in recovery and stability of the financial markets by reducing the abnormal returns. Now, in the case of Malaysia, we could not find any robust evidence. The question is that, what we actually think is that the insignificance of monetary policy announcements, the impact, the reason we don't see the impact of monetary policy announcements in our study, which is focusing on 3 days and 7 days, is primarily out of the reason that monetary actions tend to take much longer for the impact to be witnessed in the financial markets. So that is probably the reason why in our results and in our study, we don't see a direct significant impact of monetary policies measures. So, but when we look at the bigger picture, the stimuluses which have been undertaken during the pandemic have primarily been coordinated between fiscal and monetary policy measures. because the fiscal and monetary measures are complex, they are interlinked. Uh, and one takeaway that we have is that there is an increasing importance of how these policy measures are communicated. Because at the end of the day, if the objective is to give or send a signal to the markets of a calm and by the policymakers that things are under control, then communication becomes critical. Effective and balanced communication is something which is becoming more and more critical for policy authorities, um, both for communicating the intended objective as well as for credibility measures. And this has been witnessed over especially in the COVID times. Even the literature talks about the fact about communication, credibility, and of government actions across the board, all kind of government actions, and especially it becomes more critical the moment we step into the fiscal and monetary sphere. Now, the research on policy effectiveness in COVID-19 times, it's scarce. We found research on multiple aspects of financial markets, multiple aspects of broader policy, but on policy effectiveness there is a huge area where we need to work more. This area does demand a lot of more research. What our study does is it's a preliminary work, but we feel that it's important in getting the ball rolling and setting the foundation. One limitation is that we have used the policy announcement date as a trigger. We have not used the intensity of the policy announcement. So that is probably what can be in further research be factored in. And also there can be more measures for capturing the impact of policy announcements, which needs to be explored. And at this, I will stop. Thank you very much for your time, Professor Paresh. I apologize for going a couple of minutes overboard.
Okay, that was expected that you will go overboard. Thank you, An, for excellent presentation. We'll return to questions at the end of the session. We'll move to the second presentation. And the second one is on the topic COVID-19 policy responses and productivity around the globe. That paper will be presented by Bernard. Bernard, over to you. 15 minutes.
Hi, everyone. Thank you for your audience. Our paper is titled COVID Policy Responses, Productivity Around the World. And this is written by myself, Dr. Sharma, and Dr. Gunadi. First of all, I would like to discuss the motivation of our paper. The COVID pandemic has impacted economies around the world negatively. And most papers have shown that it has affected several aspects of the economy. The first one is labor force participation rate. And this Bauer and Weber has shown that it has negatively affected the labor force participation rate. The second one is on consumption and investment. A paper by you et al. Has shown that COVID has impacted negatively on consumption and investment around the world. And also in terms of corporate performance, Shen et al. Has shown that COVID has negatively affected corporate performance. And also Barrow et al. Has shown that it has led to contraction in output and credit. Okay, so the theoretical channel is clear. Here, the impact of the COVID on the economy can be seen from an economic perspective, like in the sense that it incites fear in people, and this fear in people leads to restraint in things like consumption, trying to save for the future, and staying at home or restricting from labor force activities. And for corporations, corporations like banks are willing to lend because they fear that other firms are not able to pay back. So in terms of liquidity, COVID is expected to lead to a negative shortfall in liquidity. And this would adversely affect investment and, of course, in turn, productivity. And because of the negative impact of COVID on productivity, governments have planned ahead and implemented several policies so that they can arrest this negative impact. Around the world, there were implementations of policies such as face covering, monetary policies such as the cut in interest rates, and monetary stimulus, and as well as government policies to inject finance into funding into the economy so that it can raise consumption. Several studies have shown that such policies have had either a positive or a negative impact on the effect of COVID on the economy. And for example, Ashraf has shown that such policy responses led to an increase in stock returns, but Young and Deng shows that the impact was negative. And also Big et al. Showed that the policy response, instead of improving liquidity, has led to a decline in liquidity. Now, why do we study what we do at the moment? The fact is that we look at the literature and found out that despite all the literature showing that COVID has had a negative impact on productivity, no study has shown whether the policy responses succeeded in reversing this impact. And so, as a contribution to the literature, we address this research gap. In particular, we showed that the policy responses were effective in moderating the COVID's impact. Now, how do we show this? And the first part is we demonstrated that indeed the pandemic had had a negative impact on productivity around the world. And so to do this, we regress the annualized change in industrial production indices on the lag of a COVID indicator, which is the total deaths per million as a result of COVID, and condition for other indicators. Then in the second part, what we try to do is to see whether or to what extent these policy initiatives succeeded in reducing or reversing the impact of the pandemic. So in model 2, we regress the annualized industrial production indices on the lag of COVID indicator, which is the total death per million as a result of COVID. And then we included the lag of the policy initiatives, and then the interaction of these two, and condition for the lag of the other economic factors. Now, this is how we collected the data and how we decided on the countries to include in our data set. First, we used the data set produced by our worldindata.org. And then we used that data to decide which countries were most affected. And then out of these countries, we picked 50 most affected by COVID. Our data is monthly by frequency, and it is from January 2020 to March 2021. Now, this is how we measure the variables we use in our model. First, for productivity, we use the the annualized growth rate of industrial production. So this will tell us by how much productivity has increased or decreased over a period of time. And for the COVID indicators, we use the log of total deaths per million associated with COVID. And then for the policy intervention measures, we use 5 indices, which has been compiled by Bartovic at a particular center at Oxford University. And these indices were the stringency index, the stringency legacy index, the government response index, the containment and health index, and the economic support index. Now, for the conditioning information, we followed the literature, the monetary policy literature, the monetary and fiscal policy literature, and control for these popular indicators. The first one is the change in money supply. And then the second is the short-term interest rate. The third is inflation rate. And then the final is stock returns. Then, because these variables are susceptible to unit roots, they are typically not stationary in most cases. We check for stationarity before proceeding to our analysis. The first is we use the Leveling and Chu test. And the second, we use the Impersonal and Shin test. Both tests show that these variables do not have unit roots. So we use them as they are. And so here are our first results. Our first results stem from our model 1, which will regress the annualized industrial production indices on the lag of the COVID indicator, as well as the conditioning variables. Overall, we found consistent negative coefficient for COVID. And then we found overall significance. So if you can see the table here, so here, sorry. Okay, here is the coefficient for COVID. So you can see that the signs are consistently negative, even though the statistical significance appears a bit weak. And we suspect that this is as a result of the size of the data. And this is what we think that prior literature did not work on this area. They have no access to consistent data, particularly at the daily level. You cannot find data for these variables. And we use the maximum data for the monthly, at the monthly frequency for our analysis. And so we expect that as the time frame increases, future studies will find a very strong negative impact. And this has also been confirmed by previous work. You can see in the literature showing that the COVID has actually affected all aspects of the economies, from the financial market to the labor market and to the performance of firms. And this is not a cause for concern in the sense that if you look at the overall adjusted R-squared statistics, they look economically significant. So they provide further evidence that indeed the COVID pandemic has had a negative impact on productivity.
Okay, Bernard, just 3 minutes, 3 minutes for you to highlight the main thing.
Okay. Yeah. So with regards to our main result, which is to find out whether the policy measures succeeded in reverting the impact of the pandemic, we regress the annualized industrial production indices on the lag of COVID indicator, the policy indicators, and their interactions, and the condition for the other economic factors. Now, we found that indeed COVID negatively impacts productivity. Then we also found that, most importantly, that the policy responses reverse the negative impact of the pandemic. So these are the results. So we can see that 4 out of the 5 regressions, the impact is positive. That is the interaction term between the lag of the COVID indicator and the policy indicator. So it means that the policy succeeded in reversing the impact of the pandemic. Now, what we see here is that absent the pandemic, then these policy responses would have led to a negative impact on productivity, which means that these policies were measured. So they were timely and they resolved what they were intended to do. The only exception is the last regression, and this is the way that particular variable is defined. So it captures the economic support indices, which is supposed to beef up the economy, not to restrain the economy from the spread of the virus, whereas the others were typically meant to restrain the spread of the virus. So we suspect that it is because of the nature of this particular index that doesn't measure the way the policies curb the spread of the virus led to this particular result. On the whole, the takeaway is that we found that the policy responses were able to reverse the impact of the pandemic and that they were measured. So implication is that when a negative shock hit an economy, measured policies are in place, should be in place to reverse the pattern, the negative pattern. So this re-echoes the theoretical literature on the optimal policy mix to maintain economy at a steady state, so that when an economy is hit by a negative shock, then policymakers must balance both fiscal and monetary policies as well as other policies to ensure that the economy is reversed to a positive growth path. In all, this is what our paper does. Thank you very much.
Okay, thank you, Bernard, for that. Very interesting results there. We move to the third paper. And the third paper is on COVID-19 uncertainty and monetary policy responses, evidence from emerging market economies, and again, joint work with Bank Indonesia. It will be presented by Professor Prabheesh. Prabheesh, 15 minutes.
Thank you, Professor Paresh, to present my paper. Share the slides. So the title of my paper is COVID-19 Uncertainty and Monetary Policy Responses, Evidence from Emerging Economies, Emerging Market Economies. So this paper is jointly written by my colleagues in Bank Indonesia, Dr. Solikin, Juhro, and Cicilia. So if you look at the COVID-19 outbreak and the subsequent lockdown in emerging economies, actually this crisis actually destabilized the macroeconomic conditions of emerging economies. So if you look at the recent data, even still, I mean, many emerging economies are recovery mode, are still yet to recover from the crisis. Some of the countries are still facing the second wave of COVID-19. So if you look at the policy responses from the government as well as central bank, many emerging economies, central bank adopted expansionary monetary policies in order to stabilize the economy from the shock by cutting down the interest rate. And there are different, I mean, conventional as well as unconventional monetary policies also adopted by the emerging economies. But the question here right now, how effective are these monetary policies? policies. So based on this, literature, then we are trying to address how uncertainty play an important role in the transmission of monetary policy during the COVID-19. So this is the overall presentation of my research question, motivation, and brief review of literature, then approach, then empirical model and methodology, then findings and conclusion. So again, I wanted to reiterate the research question here. This paper examines how effective is the monetary policy responses of the emerging market economies in the presence of COVID-19 uncertainty. If you look at the literature on this, basically the uncertainty, whenever there's an uncertainty in the market, then the policy can be ineffective. That is the literature I will talk about. This is mainly because the economic agent or firms typically follow kind of wait and see approach, or they postpone their investment decision due to the partial irreversibility of investment. Basically, during the period of uncertainty, the economic agent do not respond to policy changes. Basically, they wait for very credible or precise information before making their changes in investment or consumption pattern. So therefore, the literature suggests that policy may not be effective during the time of uncertainty. Therefore, the central bankers has to have an aggressive policy in order to lift the economy to the growth path. So if you look at, if you connect the COVID-19 outbreak and subsequent increase in uncertainty because of the lockdown and the reduction in economic growth, then increase in unemployment, then reduction in trade, then all leads to a hike in uncertainty in the COVID-19 time. So if you look at the trends in implied volatility, this is typically considered as a measure of uncertainty. You could see during the period of COVID in the last part. So you could see that COVID-19 period, the uncertainty has increased drastically, or there's a high shoot up. This is almost equivalent to global financial crisis in 2008. 2009. So this clearly shows that the uncertainty is prevailed or occurred during the period of COVID-19 outbreak. If you look at the responses of the central banks of emerging economies, you can also see that they followed an accommodative monetary policy by cutting down the interest rate. So if you look at this figure here, you could see that along with the advanced economies and along the advanced emerging markets cut the interest rate drastically during the period of COVID or pandemic time as compared to the pre-COVID time. So you could see that there's a drastic reduction in interest rate. Now, if you look at this as per the literature, as I suggested, the effectiveness of this policy is often being questioned under the presence of uncertainty. So we are trying to address this question in this paper. So I'll just go through a quick review or review related to monetary policy and uncertainty. You could see that monetary policy is there is a vast literature on monetary policy and transmission, but I'm just focusing on uncertainty. So what I have learned from the literature, you could see that, the uncertainty dampened the monetary policy effectiveness as compared to policy taking place during the period of certainty. So during the during the period of certainty, if at all the policies effective, then uncertainty period policy may not be effective as per the literature. Whereas if you look at the existing literature on COVID-19 and monetary policy, basically these studies are largely confined to its impact on stock market, then exchange rate and long-term interest rate. It doesn't look at actually how macroeconomic factors or something like the output, then credit, etc., is responded to the policies. So the question here, none of these studies, so the gap here, research gap here, none of these studies address how uncertainty due to COVID-19 affected the monetary policy transmission in the case of emerging economies. So this is the gap that we are going to fill here as per the existing literature. The COVID-19 and monetary policy did not look at from the uncertainty period of uncertainty point of time, specifically in the context of the emerging market economies. So this is where our contribution comes in. So our approach here, we select 14 emerging economies based on the severity of the COVID-19 crisis. Then we estimate 3 panel models, which include credit growth, output growth, and inflation as a dependent variable. Then there's an interactive effect of interest rate with uncertainty measures as independent variable. And we estimate this model using the panel ARDL method. So this is the empirical model we are trying to estimate. There are 3 models we estimate in this paper. So here, here the first model, Y includes credit growth and output growth and inflation. So this is assumed to be the target of the central bank. Central bank is trying to change the policies in order to target the credit, output, then inflation. And I represent the interest rate, that's monetary policy indicator here. Then VAX refers to the uncertainty proxy. Then ER refers to the exchange rate here. Then we extend this model by including an interaction variable here by the interest rate multiplied by VIX, that is the uncertainty. So beta 4 actually will tell you how effective is the monetary policy in the presence of uncertainty. Further, we extend this model by incorporating a triple interaction dummy by where we include a COVID-19 period as the dummy variable along with the interest rate and the VIX. So the beta 5 actually give an indication of monetary policy effectiveness during the period of COVID-19 in the presence of uncertainty. So we use monthly data from 2021, from January to 2020. Sorry, 2011, January to 2020 September. Yeah. So we choose 14 countries like Argentina, Brazil, China, Colombia, Hungary, India, Indonesia, Malaysia, Mexico, Poland, Philippines, South Africa, Thailand, and Turkey, based on the severity of COVID-19. So the proxies for the variables here, output actually we calculated from IIP growth rate, output growth, then inflation from CPI growth, then interest rate is actually considered a lending rate interest rate.
Prabheesh, you have 5 minutes, okay?
So the data, so CEIC, Federal Reserve, and IMF. So all variables are expressed in logarithmic form except interest rate. So in COVID dummy, we actually take value 1 for COVID period and 0 otherwise. So this is the panel unit truth test, where you could see that the interest rate and exchange rates are I1 or non-stationary in level, and remaining variables are I0. So I go for panel ARDL method. So looking at the first estimation on dependent variable as credit, you could see that the interest rate is statistically significant throughout the 3 models, indicate and in negative as well. So it shows that the policy is effective in stabilizing the credit growth, and a hike in interest rate leads to reduction in credit growth. Similarly, VAX, the uncertainty has found to be positive, indicating that uncertainty leads to higher credit growth. The exchange rate, again, found to be statistically significant in 3 cases, indicating that an appreciation of the domestic currency leads to higher credit availability. So this is actually, supported by the literature, where an exchange rate appreciation, when financial institutions take more risk in that case through exchange rate appreciation, specifically where the financial institutions have higher external debt. So their balance sheet becomes strengthened when the exchange rate appreciates, then they lend more. So if you look at the next case here, I mean the interaction dummy, the interaction variable I into VIX, you could see that this is negative and significant, indicating that the policy is effective during the period of uncertainty. Similarly, in the case of COVID-19 period, again, this is found to be statistically significant, at least 10%, saying that, indicating that monetary policy is effective in stabilizing the credit growth. But if you come to the long-run estimate of inflation, the story is slightly different here. You could see that the interaction variable is not significant at all as compared to the credit rates, credit growth rate. So this is something, I mean, showing that, I mean, monetary policy is weakened or it is not effective in the presence of uncertainty during the COVID, as well as in the normal in the COVID, in the presence of uncertainty. So this is not statistically significant. And if you look at the output growth as well, then the story is almost same, where we cannot find any significance on significance of related to the interaction variable. This is not statistically indicating that the policy is not effective. So this again, I mean, leading to the weak monetary policy transmission during the period of COVID-19, especially in the presence of uncertainty. So this all two output growth as well as inflation. I mean, we could find out that we could see that the agents or financial or institute or the agents or economic agents or firms follow a wait and see approach during the period of high uncertainty in the COVID time. So they are not responding to policy as compared to credit growth. But credit growth, we could find that there is a effectiveness, probably because the credit could, I mean, credit growth can transmit to a very fast policy rate, can move to very fast to the credit growth as compared to the real variables such as inflation and output, where, I mean, there can be probably a lot of can be a lax in the transmission process. So given this, we are concluding here the paper examines the effectiveness of monetary policy of the emerging economies during the COVID-19 pandemic. And in the literature, it is argued that the effectiveness of monetary policy transmission is weak in the presence of uncertainty. And given the severity of COVID-19 pandemic, we choose 14 countries from the emerging economies list, and examine the policy transmission to credit growth and output and inflation. So our findings suggest that the uncertainty actually weakened the monetary policy transmission to output growth and inflation, specifically during the period of COVID-19 pandemic. The weak monetary policy transmission reveals the agents for a wait-and-see approach during the period of high uncertainty. So, however, the relatively strong response of credit during the period of pandemic, so this could be due to the quick response of credit as compared to real factors to the policy. Therefore, the importance of credit channeling during the uncertainty may be effective. So the credit channeling could be more effective during the period of uncertainty. So in this scenario, we are also suggesting that alternative policies such as macroprudential policies may complement with interest rate policy to attain overall macroeconomic stability in emerging market economies. Thank you, Professor Paresh.
All right. Okay. Thank you, Prabheesh. We move now to the next presentation, the last one, and I'm trying to share the screen. I'll present this one. Okay, so this is a paper on the volatility spillover of intraday exchange rates on selected Asian countries. Again, joint work with Bank Indonesia, Dr. Iman and Aryo. And now what I want to start with is what is the motivation why we look at exchange rate shocks in the way we do for the region. So the theory is very clear with this, and I want to explain a bit about the intuition, the logic, and then move straight to the results to show you what we find. So the idea here, it goes back in international economics, and those of you working on monetary policies and international economics would know that there has been a long-standing debate about the factors that actually predict exchange rates, and that's very important for policy making. This goes back to the early 1980s when research was done to show that random walk models were better predictors of the exchange rate. And what it meant, random walk means you use the exchange rates to predict exchange rates. What it meant, and that led to controversy, was that there was very limited role for macroeconomic fundamentals in predicting exchange rates. And what are these fundamentals? These are money supply, output, interest rate. So by finding less role for these fundamentals, this created a lot of debate and a lot of research around the relative importance of fundamentals versus the random walk model. If the random walk model performs in a superior way, as it was shown by Messi and Rogoff in the early 1980s, then obviously you don't have to worry about fundamentals. And that was the big debate, and that's where I guess a lot of tensions were developed. So what we are doing here, in light of the pandemic, obviously, is to see what has actually happened to the exchange rate behavior, and more so from a shock point of view. So that's what we do, and the implication of that is it will again go back to explain whether there's a need for us to look at fundamentals, even in this pandemic time, in explaining exchange rates, or do we still depend on the random walk model despite the crisis that we are experiencing? So that's the idea of this paper. I'll skip the literature. Okay, I'll get to the data. So this data is interesting because we use hourly data here, and it goes from 2018 to 2021. We have 5 ASEAN countries plus China for robustness tests, Singapore, Malaysia, Indonesia, Philippines, and Thailand. The data comes from Datascope. Methodology is very straightforward. We use the Dabbled and Ilmer's model to extract the relative importance of shock. So you can think of this like a variance decomposition type shock where there's 2 components that are of interest here. The first is how does a shock in exchange rate in a country affect its own exchange rate? So that's what we call own variance shares in forecasting the exchange rate. And the other one is obviously, if you have other exchange rates that matter to you, we are able to extract the relative importance of those shocks as well, and that is known as the cross-variance shares. So how other shocks affect one's own exchange rate. So it's own impact versus others' impact. So that's the way to think about this. Exchange rate returns. So this is a typical way to measure exchange rate returns. That's what we use, and we use a Gauch model to estimate its variance. Okay, so that's the exchange rate. That's not the important thing. The important thing I want to get to is the results. So you know what the theory is. This is a debate about random walk model versus the fundamentals. That's what it is all about. What we have here is very interesting. This is the full sample. So this full sample is 2018 to 2021 hourly data. The first one is IDR, is Indonesia exchange rate, then that's the Malaysian, Philippines, Singapore, and Thailand. The ones in color are the relative importance that I want to pay attention to, the red ones and the green highlighted ones. The point of this is the green ones, they measure own shocks. So the relative importance of own shocks in explaining the volatility of one's own exchange rate. The red ones are the relative importance of other exchange rates to one's own exchange rate. So the way to think about this is if we look at 36.31, the interpretation is that for the volatility of the Indonesian exchange rate, 36% of the variance is coming from other exchange rates. And the other exchange rates are Malaysian, Philippines, Singapore, and Thailand. And if we look at the value of 63.69, it is saying that around 64% of the variance in Indonesia's exchange rate is self-explained. So that's the random walk component, right? So again, what you can see from this story here is that the own shocks, as you move across that diagonal, 85% in the case of Malaysia, 80% in Philippines, and 76 and 75% respectively in Singapore and Thailand. The bulk of the variations in the exchange rate volatility is coming from own shocks, which is consistent with the random walk model, suggesting that there is limited role for fundamentals. When we look at in the rankings, you see that in the case of Indonesia's exchange rate, 36% of the variations, that's one third, more than a third of the variation in Indonesia's exchange rate is coming from exchange rates of others. So in this way, in a comparative sense, the Indonesian currency is more synchronized with the other countries in the Asian region. That's the main takeaway. The others are less so. So in the case of Malaysia, it is least affected by others. Only 14% of the variation in its exchange rate is due to other exchange rates. Whereas the others are about a quarter, like Singapore and Thailand. So really what is striking here is that Indonesia's currency stands out, and we'll look at that in some other detail. So here's a split of the pre-COVID sample versus the COVID sample. And again, what you see is, if you focus on Indonesia, 35% of the variation in the exchange rate before the crisis was due to other shocks in the exchange rates. In the COVID sample, nothing much has changed. So, still fairly dominant, 36%. So we can't say that the pandemic has made a difference to the behavior of Indonesia's exchange rate. Similarly, with the others, you find that like Malaysia is at 14%, 13%. So there's hardly any change due to the pandemic. Own shocks, like you can see in the green ones, again, this is, when I say own shocks, we're thinking in terms of theory, the random walk model. The random walk model is still very strongly valid in this case, both pre-pandemic as well as during the pandemic. We can see that the bulk of the variations are coming from one's own exchange rate shock. Again, the standout currency in this pre and pandemic phases is the Indonesian currency, with about 36% of the variance in the volatility coming from shocks to other exchange rates in the system, which is the Asian region. Okay, so what are we concluding? Well, let's look at some things we did for robustness. We included the Chinese RMB to see if the results were going to change in any way, because China obviously is a big trading partner and a bigger player in the Asian countries. So we included China in this model, and you can see again that Indonesia, if anything, the variance of the Indonesian currency actually increases due to the other shocks. So for the others, Malaysia is still low. It's about 16%, so least affected. So what it means here is that even when we include China, the fact that the Indonesian currency is most affected by other currencies in the region is important finding, and it holds regardless of whether or not we include China into this. Again, we do the same thing by including China in the pre-pandemic and the pandemic phase. And again, we find that in the case of Indonesia, the variance in its currency is mostly driven by shocks to currencies of other countries in the region. And own shocks continue to dominate. So again, what it means, there's two messages here. One is that the random walk model is still very much valid in explaining the variance in exchange rates of the Asian countries, including Indonesia. However, in a relative sense, when you look at it, if the question was, did the did shocks to currencies in the Asian countries led to changes in the Indonesian currency? The answer is yes, because about 45% of the variance in Indonesia's currency is coming from shocks to other exchange rates. So yes, the random walk model still holds, but in the case of Indonesia, slightly different. There is a decent, at least a third to about 45% of the changes to the currencies coming from shocks to other exchange rates. Okay, so why Indonesia is so different? That's the main takeaways, and this is the main highlight of the paper, is that Indonesia is quite different. It's more synchronized. It matters more to Indonesia what happens to currencies in the region than to other countries. And one of the reasons is because Indonesia has got a thin foreign exchange market. This is due to small volume and lower transactions, frequency of transactions, foreign transactions. There's a lack of USD dollar supply due to persistent current account deficits. So Indonesia has a history of persistent current account deficits. And what it all means is that Indonesia is more vulnerable to negative sentiments in the market, and such as due to sentiments due to the pandemic, which creates greater uncertainty. Particularly when it affects international trade the way this pandemic has affected. So therefore, what it means is that it is the Indonesian rupiah has continued to depreciate, and there will be higher volatility in the market, which you cannot avoid. Okay, so that's what we do. We do a whole range of robustness tests, which I don't want to talk about because we don't have the time for that. But just to add to this, we estimate different VAR models. We estimate different rolling windows of different sizes. We take care of different forecasting horizons. So we cover all the angles from the point of view of robustness, as has been done in the literature. So we do all that. So the point here is that when we conclude, and we conclude with the following message, is that when we look at the Asian countries and the exchange rate, Indonesia stands out because the rupiah is the most affected by exchange rate shocks in the Asian region. And it's in the magnitude of 35 to 45% of the variation in the rupiah happens as a result of shocks to others. Malaysia is the least affected, almost only about 15% of the Malaysian exchange rate volatility can be explained by others. The other main story here is that the own shocks to one's own exchange rate has got a bigger role to play. So almost 60% to 85% of the variation in exchange rates for Asian countries is explained by their own exchange rate shocks. What it means then is that the random walk model holds very strongly, and there is limited role for macroeconomic fundamentals in shaping the exchange rates of Asian countries. The only exception, as I said, is Indonesia, and we have provided an explanation as to why that is the case. So we hope that using this as a preliminary study on exchange rate shocks, there can be other studies exploring other aspects of this exchange rate dynamics. All right, okay, so that's where I stop, and I think what we will do now is we will open the floor for questions. You can either type in your questions or raise your hands to ask questions, and you can direct it to the specific presenters, and I will accordingly direct it to them. We will do this for the next 10 minutes, and then we will conclude. Okay, I've got some questions in the chat, so let me see who is asking this. Okay, so there's a question for me. It's asking the drop in other shocks in CNY volatility during the pandemic seems interesting. Does this imply that the Chinese currency was quite sensitive to other Asian currency volatility pre-COVID? Yeah, I think so. This is interesting because the global trade, you see that one of the biggest difference in this pandemic is that the global trade was affected immensely, and China was affected as a result of that, because China exports to almost every country in the world. So the biggest impact was felt on China's trade with other countries, and naturally the exchange rate was affected by that. So you can see that when we introduced the Chinese currency, the Chinese currency itself, about 44% of what was happening to the Chinese currency was actually dictated by what was happening to exchange rates in the Asian region, which is quite significant because China exports heavily to the Asian countries. Okay, and that result holds regardless of how you model the relationship. Okay, any other questions on there?
I think, I don't know whether it's Mr. or Mrs. Mayati asked me to explain what policies ASEAN countries and Indonesia in particular can adopt to improve productivity as they face COVID. Okay, so my answer to this question is that our paper seeks to see whether the current policies have been effective in reverting the negative impact of the pandemic. So our answer is that yes, the policies were effective. And so for Indonesia and other ASEAN countries, I suppose these policies like implementing stimulus packages, small but significant cut in interest rates, and instituting policies like social distancing, face covering, and things like that would improve the situation. First, the first part, which is more social policies, will ensure that they can reduce the number of cases per day. And the second policies, which are the fiscal and monetary policies, will beef up consumption, improve investment activities, and also improve overall productivity. He or she suggested that what are my comments with regards to the SWF. I don't know what that means, but I don't know much about this policy. But if it is to improve consumer confidence and producer confidence, it is in the right direction. So this is my response to that particular question.
Okay, thank you, Bernard. There's some other questions on the chat. I think this one is for Prabheesh.
Yes.
For countries that do not have a VIX, that's the volatility index, I think, can we use other proxies or other approaches?
Yes, I think, depends on the availability of the data. For instance, APAEA also constructed uncertainty index for COVID, so that can also be used as a proxy for uncertainty. If not, VIX is not there. Thank you.
Okay, thank you, Prabheesh. There's another one. Another question is about, I think this is to me. What I want to know is what does it suggest to countries, policymakers with respect to their exchange rate policy? So I think this is interesting because what it means, at least for Indonesia's case, in the case of Indonesia, the fact that fundamentals are not having a strong enough effect, what it means is that any sort of monetary policy signals, such as through the interest rates, are not going to have any dramatic effect on Indonesia's exchange rate. That's what our results seem to imply. So as the effectiveness of monetary policy kicks in, we will be able to understand much better the volatility of the Indonesian currency. But that is what one of the implications, and obviously the other is for the other countries in the region, such as Malaysia, in the case of the ringgit, where only 15% of whatever happens to currencies outside Malaysia matters to Malaysia. I think this has to do a lot with the fact that Malaysia has had a fixed exchange rate for a long period of time, and that may explain why the effect is not so pronounced for Indonesia. Sorry, for Malaysia in this case. So yes, that's my response. Anybody wants to add to that? Importance of exchange rate policy for policymakers. Okay. Any other questions from the audience?
Professor Paresh, if you may allow. Yeah.
Yes, please.
Yeah, there's a question from Mangaras Krasi. The question is total policy responses to be 77 and filtered on policies on what measures. So the idea of filtering was that, for example, like in monetary policy announcements, when we got the monetary policy announcements, there were some monetary policy announcements which talked about lowering the policy rate. There were some which talked about changes to the requirements for statutory liquidity requirements of the banks. So all of these measures do impact, do have a quantitative nature to it. But then there were some policy announcements which basically were just the fact that, the policy rate remains unchanged, and that's it. So so the idea was to filter and then there were some on guidance announcements. So there were some announcements which were based on the fact that, all of this is being done by the Ministry of Finance, and we are looking into the data, and we will be trying to adjust some of the major economic numbers. So those are policy announcements and statements, but they do not have a quantitative angle to it. And that's how we filtered it. But we also mentioned that this is just a preliminary, and there one thing which we were not able to capture, and which I've also mentioned right towards the end, is the intensity of the announcement, which is probably a major room for future research. Thank you, Professor Paresh.
Okay, thank you, On, for your response. Now we've got a couple of minutes left. Can I ask our co-authors from Bank Indonesia if they want to add to any of the things that have been discussed? I know that our co-authors are there, or at least they were there. So if anyone wants to add to something, please, you are welcome to do so now. Okay. Somebody had raised their hands, so I cannot see who the person is. If you want to speak, yes, Sylvie Asna, you can ask your question directly. Yeah, Mohammed Pratama, you can also ask.
Okay, good afternoon, everyone. So, I want to ask regarding to Mr. Iyke, why do you consider using the index of industrial production as the measure of economic output? Well, why don't you just like you employing the interpolated of gross domestic product from the conversion from the quarterly into a monthly data? And also, well, it is quite interesting to note that there's the relationship between the COVID-19 and the economic output is such an important. So the dampening effect of COVID-19 is relatively, the research regarding it is relatively scarce. And why don't you employ the test for robustness, like for using the retail sales index as the another proxy for the economic output?
Okay, Bernard, question is to you.
I didn't hear the second question properly. The
Okay, just answer the first one.
Okay, so the first one, Mr. Sylvie is suggesting that we use GDP instead of industrial production index. The reason is simple. Extrapolating GDP, which is at quarterly frequency, to monthly frequency increases the risk of measurement errors. So this is an issue that has been debated in the literature. So often, when a study uses monthly data, the preferred index for measuring output is industrial production, because industrial production is usually signal the direction of an economy, whether people are employed and whether these people are productive. So, and most advancement in economic activity comes from both innovation and industrial production. So we believe that using industrial production is the best we can at the moment. If you reduce our samples to quarterly frequency, then we have very few quarters to do our analysis, which is basically the problem, the challenge the literature faces at the moment. For your second question, you stated that we use another variable, but I didn't get that clear. Can you repeat it?
Okay, we'll give the second person a chance to ask the question. Sylvie, you can ask now.
Yes, thank you. Okay, I'm Sylvie from Universitas Brawijaya Indonesia. I would like to send my question to Mr. Bernard Njindan about the policy response. You mentioned before that the policy can increase the productivity of the business, right? But in Indonesia right now, we have a good policy actually from the central. I mean, from the president. But after that, after the president delivered the policy to the regency, to the city, and to the village, it makes bad policy. I mean, many corruption happen. So it makes me sad actually, because if we see many our people die, our people suffering, our people have poverty, but how come they make a policy and then they make the corruption for it? So please, your opinion or your your opinion or your suggestion on how policy should be to reduce the corruption and to increase the people welfare in this COVID-19. Thank you.
Okay, thank you for your question. This is more politics more than, but I would like to answer it this way. For policies to be effective, you need the institutions to be also effective. So this is a whole idea altogether. The current idea is that the policies introduced by the other countries, which are listed as under stringency, restricting people from moving, injecting investment funds into the system, cutting down the cost of borrowing, will improve economic activity. But it will only do this if the systems are effective. So if the institutions are effective. So if institutions are effective, it will reduce incidents of corruption and bribery. So I think that going forward, if the president wants this policy to be effective, then he has to first tackle institutional effectiveness. So the institutions must be must be made to stop corruption activities. So which means that there must be effective monitoring system in place if these policies are to work. But we know that from around the world, and the evidence suggests that restrictive policies like the social distances are the way to go if you want to curb the spread of the virus. And also introducing vaccination. People should be encouraged to go for vaccination. I don't know how effective that is, but the scientists have shown that vaccinations work. And so this is my response to your question.
All right, okay, so I think we should bring this interesting session. There are still questions coming in, but I don't think we have the time to entertain those questions, but you're welcome to write to us at any time on the email, and we will try our best to respond to those. I want to thank again all the presenters and all the co-authors for working together to produce 4 very good quality research papers on this very, very important theme of the pandemic and monetary policy. Thank you again to Bank Indonesia Institute for jointly working with us. Using these researches very soon in the BMEB, the Bulletin of Monetary Economics and Banking, the flagship journal of Bank Indonesia. These papers will be published in there, and obviously we want to publish it as soon as possible because these are important themes. People are working on it. People are interested in them. So you'll be able to read that within the next 2 to 3 months' time. So thank you very much, and I really appreciate your participation. We had a very good, almost 340 people attended the session. So I thank all of you for your participation, and let us bring this to an end now. Thank you very much.
Thank you.